Does money feel like a mystery to you? You work hard, get paid, and somehow it all disappears before you know it. Welcome to the world of finance, where making informed decisions about your money can be the key to unlocking a more secure and prosperous future. As a beginner, it's natural to feel overwhelmed by the complex terminology and concepts that come with managing your finances. But don't worry, we're here to break it down in simple terms so you can start building a stronger financial foundation. Budgeting, your financial blueprint. Let's start with the basics. Budgeting is a process of tracking your income and expenses to ensure you're making the most of your hard-earned cash. It's essential to understand where your money is going so you can make conscious decisions about how to allocate it. Think of budgeting like cooking a meal. You need to have the right ingredients in the right proportions to create something delicious. In this case, your ingredients are income, expenses, savings, and debt. There are two main types of budgets, fixed and flexible. A fixed budget is when you allocate a specific amount of money for each expense, while a flexible budget is when you adjust your expenses based on your income. The 50-30-20 rule is a good starting point for budgeting. 50% of your income should go towards necessary expenses like rent, food, utilities, and minimum debt payments. 30% wants should go towards discretionary spending like entertainment, hobbies, eating out, and shopping. 20% towards saving, investing, and debt repayment. A budget gives you financial freedom, not restriction. It's like having a GPS for your money. Set it and follow it. Basic finance terms you should know. Now that we've covered budgeting, let's talk about some common finance terms. Income, money you earn from a job, business, or investments. Expenses, money you spend on things like rent, bills, and food. Assets, things you own that have value like cash, property, or stocks. Liabilities, money you owe like loans, credit card, or mortgages. Net worth, your total assets minus your total liabilities. Amortization. Amortization is when a loan is paid off over a set period of time, with each payment reducing the principal amount. Yield. Yield is the return or the interest earned on an investment. Compound interest. Compound interest is when interest is earned on both the principal amount and any accrued interest. Knowing these terms help you understand how money moves. The power of compounding. Now let's talk about the power of compounding. Compounding is when interest is earned on both the principal amount and any accrued interest. This can lead to significant growth in your investment over time. For example, let's say you invest $1,000 in the stock market, which has an average return of 7% per year. In year 1, you start with $1,000. By the end of the year, with 7% return, you end up with $1,070. You then start year 2 with $1,070. By the end of the year, you end up with $1,144.90. Keep going the same pattern in year 5, you end up with $1,403. Continue the pattern. In year 10, $1,967. So instead of earning just $700 over 10 years with simple interest, compound interest allows your money to grow exponentially. The key? Time and consistency. The earlier you start, the bigger your returns. Basic American taxes. What you need to know. Taxes can be overwhelming, but let's keep it simple. In the US, your income is taxed at different rates depending on how much you make. There are several types of taxes, including income tax, sales tax, and property tax. Property tax is a tax on real estate or property you own. Sales tax is a tax on goods and services you spend on. Income tax is a tax on earnings. The tax brackets are like a ladder, where the more you earn, the higher the tax rates. Let's break down some simple terms. Federal income tax. The more you make, the more you pay. Progressive tax system. State and local taxes. These vary by the state you live. Payroll taxes, Social Security and Medicare, usually taken out of your paycheck. Capital gains tax, a tax on profits when you sell investments. Deductions and credits, ways to lower how much tax you owe, like student loan interest or child tax credits. Understanding taxes help you keep more of your money. How to start investing even if you're a beginner. Now that we've covered budgeting, finance terms, taxes, and compounding, let's talk about investing. Investing is when you put your money into assets that have a potential for growth, like stocks, bonds, real estate, or a cryptocurrency. Investing sounds scary, but it's actually simple. You can start with as little as $50. The stock market is like a big store where you can buy and sell shares of companies. The average return on stock market is around 7% per year, but it can vary depending on the market conditions. Ways to invest: 401k or IRA, retirement accounts with tax benefit, index funds or ETF, index funds, a mix of top-performing stocks, great for beginners. ETF or exchange-traded funds, like index funds, but trade like stocks. Individual stocks, buying shares of companies like Tesla or Apple. Remember, higher risk, higher reward. Just a brief touch on investing, but do your own research. Start early, stay consistent, and watch your money grow. The dangers of not investing. Let's talk about a huge mistake people make: letting money sit in a checking or savings account instead of investing it. We have two scenarios. Let's compare them. In scenario 1, you have $10,000 in a saving account. So most saving accounts offer only 0.5% interest per year. In the span of 10 years, your $10,000 grows to $10,511. In scenario 2, investing $10,000 in a stock market. The average stock market returns 7% per year. So in 10 years, $10,000 grows to $19,672. That's nearly double just for investing. Your money loses value if it's sitting in a bank. The secret to wealth? Compound growth. However, it also comes with risk, like market volatility and inflation. So do your own research. Take the risk you're comfortable with, but don't let your money just sit in the bank. Principle to build wealth over time. Wealth isn't built overnight, but anyone can do it with the right habits. Step to building wealth. Number 1, spend less than you earn. Live below your means. Number 2, save and invest consistently. Even small amounts add up. Number 3, avoid high interest debt. Number 4, increase your income. Side hustles, promotions, learning new skills. Number 5, be patient. Time plus compound growth equal financial freedom. Number 6, start a business. Work for yourself. When the time is right and you have a business idea, do it. It can be selling some handmade, like crochet, or flipping your old stuff online. Start today and your future self will thank you. Managing money doesn't have to be stressful. But with budgeting, investing, and smart spending, you can build a future of financial freedom. The best time to start was yesterday. The next best time, right now. And also, if you want to know whether you should buy or rent a house, check out this video.